no great surprises here. What are you reading, though, when you look at the interest rate swap curves and other markets? What are you reading as to when things are going to start changing?
Well, the interest rate swap curves, the OIS curves, provide a fairly good indication of market expectations for the bank rate going forward. Now, the market's fully pricing in a rate hike really towards the end of spring next year. But the balance of expectations switches to a rate hike in January 2015. So that, in a sense, is when the market is expecting the MPC's first rate hike.
All right. Just seeing that the bank says it's going to reinvest just over 8 billion sterling of proceeds from QE. How significant is that number?
Fairly insignificant in terms of overall financial market behaviour. Really the key driving force behind money markets and the bond markets more generally is expectations relating to the timing of this first rate increase from the bank. So these changes affect things very much at the margin. They don't really have that much impact on money market liquidity. So the net effect on money markets and interest rate expectations is minimal.
Okay, all right. Reuters did a poll at the end of February. I just want to go through this with you. 47% of economists said, well, they were asked the forward guidance strategy from the bank. Do they want to see more or less clarity? 25 said they want to see less. 22 said more. I mean, it's pretty split that. Where do you stand, and what do you think we need to see? What does the bank need to do and say to get more clarity, do you think?
Well, I'm not sure it really needs more clarity. I mean, it's giving us a very strong message that, rate increases are going, when they do start, are going to be very moderate. I think it's very difficult for them to attach, as they did, forward guidance to any specific economic indicator. That's just it hasn't really worked in the past, and I don't think it would work in the future. And so it's fairly sort of non-quantitative forward guidance is what the market needs, and just a continual reassurance that we're not going to see the bank moving ahead of the curve and starting to raise interest rates earlier than expected and at a faster rate than generally.
All right.